Hey guys, this is your host Nitin Binhani, and a very warm welcome to my startup podcast channel Jazair Audio, where we share real stories with real learnings.
Today, we have a troubling case to discuss, the story of MobiKwik's IPO losses and how retail investors often end up on the losing side when investing in tech startups' IPOs.
First, the disclaimer. The content of this podcast is based on media reports and is for informational purposes only. We do not verify the accuracy of the information presented, nor make any claims about the startups or individuals mentioned in this podcast.
Let's dive the story into 5 parts. Part 1. Launch of IPO. MobiKwik Systems Limited, the parent company of the payment solutions provider MobiKwik, was founded in 2009 with a grand vision to create a digital financial ecosystem accessible to everyone. It started as a mobile wallet service, but subsequently expanded into lending, insurance, and wealth management over time. Fast forward to December 2024, MobiKwik launched its initial public offering, IPO, hoping to capitalize on the growing fintech boom. Investors, both big and small, rushed in, and the demand was staggering. The IPO was oversubscribed 119 times, making it one of India's hottest tech listings ever. Part 2. Anchor investors and institutional backing. Ahead of the IPO, MobiKwik secured rupees 257 crore from several big-name institutional investors. The lineup included heavyweights like the Government Pension Fund, or Norges Fund, Morgan Stanley Investments, HDFC Mutual Fund, SBI Mutual Fund, and Axis Mutual Fund. This institutional backing gave retail investors confidence. After all, if the big players were buying in, surely MobiKwik was a strong investment, right? Unfortunately, this assumption proved to be dangerously misleading. Part 3. The financial mashup. Here's where things get interesting and suspicious. For nearly 15 years, MobiKwik was consistently running losses. But miraculously, in the financial year leading up to its IPO, it suddenly became profitable. Let's look at the numbers. In FY 2023, before IPO, the revenue was Rs 561 crore, with a loss of Rs 83 crore. Miraculously, in FY 2024, just before IPO, the revenue was Rs 890 crore, with a profit of Rs 14 crore. In the first 9 months of FY 2025, after IPO, the revenue stands at Rs 915 crore and the net loss is of Rs 62 crore. See the pattern here? A company that bled money for over a decade magically turned profitable just before its IPO, and once the IPO was done, it slipped back into losses. Was it coincidence, or was something else at play here? Part 4. The post-IPO stock price reality check. MobiKwik's IPO was launched at Rs 280 per share, and the stock debuted at Rs 442, a massive 59% premium. For a moment, everything looked golden, but within months, the stock saw a steep fall to Rs 302 by March 28, 2025, a 61% drop from its post-listing high of Rs 615. It once even fell below its IPO price of Rs 269, leaving retail investors deeply worried. The worst part being those who invested in MobiKwik's IPO based on its sudden profitability are now caught in a financial trap. Retail investors, expecting strong performance post-listing, are left holding the bag, while venture capitalists and institutional investors seem to have walked away with profits. Part 5. Possible manipulations. Now, let's talk about what might have gone wrong. How did a company with 15 years of losses suddenly turn profitable, only to slip back into the red? Here could be 5 potential reasons indicating manipulations. A. Creative accounting. Did MobiKwik play with its financials to show profitability before the IPO? Maybe they delayed expenses, reclassified revenue, or manipulated their gross merchandise value, GMV, to inflate their earnings on paper. B. Anchor investor injections. By raising substantial money from anchor investors, the company could have temporarily boosted profitability, making financials appear healthier than they really were. C. One-time revenue boosters. The company might have launched specific app-based services that generated quick, short-term revenue, but once the IPO was done, these revenue sources dried up. D. Hidden liabilities. Did they push debt obligations down the road to present an artificially strong balance sheet? The significant increase in interest payments post-IPO suggests this could be a possibility. E. User complaints and liquidity issues. Many users reported negative experiences with MobiKwik, with funds stuck in the app or facing difficulties in withdrawals. If customers lose trust, revenue can decline, leading to poor stock performance. So, are IPOs in India just a VC exit strategy? MobiKwik is not an isolated case. In India, many new-age tech startups have followed a similar pattern. A. Raise massive VC funding for years while running at a loss. B. Just before IPO, show a sudden jump in profits. C. Launch a hyped IPO, get retail investors excited. D. Post-listing, the stock crashes, and retail investors are left to suffer with losses. Wonder, what is SEBI doing? This begs a serious question. Are IPOs just an exit strategy for venture capitalists? If so, how can retail investors protect themselves? Finally, lessons for retail investors. So, what can we learn from MobiKwik's IPO in similar cases? Here are 5 key takeaways. 1. Don't trust pre-IPO profits blindly. If a company has been unprofitable for years and suddenly turns profitable just before an IPO, be skeptical. 2. Watch out for anchor investor influence. Just because big institutions invest doesn't mean a stock is a sure bet. Their goals are often for short-term returns versus the long-term bet of retail investors. 3. Look beyond revenue growth. Revenue alone doesn't mean financial stability. Check net profits, liabilities, and cash flows. 4. Study post-IPO performance of similar companies. If other tech IPOs have crashed after listing, be extra cautious. 5. SEBI's role. The Securities and Exchange Board of India, SEBI, should ensure stricter regulations. But as of now, many questionable IPOs are still being approved. So, investors need to stay vigilant. MobiKwik's IPO story serves as a harsh reminder that the stock market can be a battleground where institutional investors and venture capitalists often hold the upper hand. Retail investors need to be cautious, conduct deep research, and think long-term before jumping into IPOs based on hype alone. There have been many tech IPOs that are available at the right price post the 3 months period. So, next time you see a tech startup IPO that looks too good to be true, be the smart investor and ask, who is really making money here? As a retail investor, what do you think of subscribing to tech IPOs on or after listing date? Let us know by commenting on the podcast. Folks, that's it for today. Thanks for tuning in. Please like, comment, and subscribe to the channel. Join us next time as we continue exploring the dynamic world of startups and the valuable lessons from their journeys.